Got it. Let's click got it. Oh, there she is. Hi. Welcome. Cool. All right. Welcome, everybody. So like I just kind of started talking about beforehand, everybody's kind of dealing with a very similar situation right now, right? How we're trying to explain the benefits of purchasing a home when rates are going up, and everywhere on the news right now we're seeing how much more expensive it is, comparatively speaking, to last year and the year before, when rates were so incredibly low. And now they're still low, but they're just higher than they were last year and the year before. And so it's incredibly misleading when you see how, home or mortgage affordability is like just way too expensive compared to the last couple of years. So a lot of the conversations I've been having with a lot of the agents that I work with is just trying to convince someone of the actual benefit in owning a home compared to renting. And that's really what we're going to dive into today. There's going to be a lot of numbers, okay? Don't get too scared about that. Like, I'm here to guide you through the numbers, but there are a lot of numbers to help you understand the benefits, because when we talk to people about buying a home, it's always, there's tax benefits, right? But do you guys actually know how to explain how the math works? Or even if you don't want to or need to explain how the math works, just understanding how impactful the math is when you look at the tax benefits of renting compared to owning. Makes sense? So that's what we're gonna do. So if Haley can hear me, let's see the next slide. There we go. And maybe move that thing so we can see, move the box from the top.
Move your bearded man.
Isaac can't move his square, but Haley can. I believe that says understanding tax deduction. Hi, Haley. Oh yeah, you need the mouse. There you go. Yes, in the top left-hand corner. Great spot for it. So basically, understanding a tax deduction. This is the bread and butter of what you really want to lean on when you're trying to explain the difference between renting and buying as it relates to a tax, like your money in your bank account, right? And it all comes down to a tax deduction. So understanding a tax deduction is like the first key piece. And I think I saw you just take a picture, and that's cool, but we're also going to be sending out this PowerPoint presentation to you guys, because there's other stuff that you guys might want to use on later slides too. So you'll get this. Understanding a tax deduction. If you have 100,000 in income and your 24% income tax rate, if that's your tax rate, that's 24,000 in a year, right? Now, when you own a home, let's say, no, we're just starting with round numbers here, because the actual tax deduction that you're going to experience on your mortgage interest is going to change, right? That is changed by your interest rate, the amount of your principal balance. All of that is, completely variable, but the most important thing is to understand the basics of how the calculation works. Hi, Leslie.
Hi, sorry.
That's okay. Welcome.
Thanks.
So if you, first of all, who really goes through tax deductions at all? Who's super familiar with tax deductions? Or is it, okay, cool. I'm getting a couple shakes on no. That's good. Okay, I just wanted to make sure that I wasn't going over something that you guys are like, this is simple. I know exactly what this is. Okay, cool. So easy to understand. You have the 100,000 income, 24% income tax rate, which means you're paying $24,000 a year in income tax. That's going to be based on the federal tax rate. You can find those on the IRS websites. Keep in mind, there are effective tax rates that can be slightly higher. They'll include state tax, state income tax, things like that. But really what we're just going to keep our education to today is just the bare bones of understanding the basic federal income tax rate. Now, if you have a $20,000 tax deduction, or as they call it, a write-off, if you have $20,000 as a tax deduction, that means that instead of paying $100,000, or I'm sorry, income tax on $100,000, you're only paying income tax on $80,000. Okay, so that $100,000 is $24,000 a year, and then if you have a $20,000 tax deduction, that means you're only paying $19,200 a year because you're only paying that income tax on the $80,000. Now, obviously, you have the difference between the $24,000 and $19,200 is going to be $4,800. Now, the important thing to remember there is really any deduction that you have is going to be multiplied by your tax rate. Is this going over anybody's head?
I'm late, so I'm
Okay.
a little lost, but that's my fault.
No problem. If you have a tax deduction of 20,000, that means you don't have to pay taxes on 20,000.
Right.
What kind of
Oh, yeah.
income tax would you have had to pay on that 20,000?
Hold on.
Mute your Zoom thing, Jim.
Okay.
Okay, that's my boss, everybody. So happy he made it on here because he's the one that really taught me all this stuff from the beginning. So that $20,000 that you now don't have to tell the IRS that you're paying income tax on this because you have a deduction, right? So your tax benefit is equal to what you would have had to pay in tax. And what you would have had to pay is 24% because that's your tax bracket. Does that make more sense now? Okay. So if you made more money and you're in a higher tax bracket, then your tax benefit would be larger, right? So that's why a lot of times when I have conversations with people who don't have kids yet, or they're not married yet, and they're making 200,000 or 250,000 a year, I'm like, whoa, you're paying way too much money in income tax. And the easiest, quick way to get that income tax savings is by purchasing a home. There are other easy ways. You could just go get married real quick or go have a kid real quick, but that comes with other implications. So let's focus on owning a home, right? Cool. Haley, let's take a look, or I'm sorry, does anybody need any further explanation on this first slide?
No, I have a question that you might get to. I thought
Sure.
there was a cap on how much you could deduct.
So that is correct. What you're referring to is, as far as the mortgage interest is concerned, is any interest on loans that exceed 750,000. From 750,000 to $1 million, those loans, they have a special calculation. And that's the exact verbiage that my CPA gave me. They were like, it's a special calculation. So really, if you have someone who's buying and their loan amount is over 750,000, then that person might not be a first-time home buyer, right? So they probably understand at least some of the basics of it, but also we're looking to convert, in this conversation, looking to convert renters to buyers, and most renters are gonna have their initial loan amount below 750, and so that's why I didn't delve too deep into that for today. But you are absolutely correct. There's a calculation.
But there's not like a cap at like 10,000 or something. I don't know where.
Did you look at all my slides? Because that's on my next slide, Michael.
No, I
Okay. Then you're exactly right. It's on the next slide, but it's slightly different, and we'll get into that.
It's okay. You finish
Yeah.
and then I'll.
I do have a question really quick.
Sure.
Can your income tax bracket lower if you have a tax deduction large enough?
Yes, because it's adjusting down your effective tax rate. Like your adjusted gross income is actually the term that they'll use.
Okay, because in the previous slide, I think the 80 grand was multiplied by the same income tax rate of, I think it was 24%. So, but that could change if, like, let's say you got like 40 grand tax deduction, then.
That's correct. Absolutely. And also there's going to be tax brackets that change for single individuals. And then there's also going to be a different tax bracket for married individuals. And so it's important that when you go through this process of educating people, that you talk with someone who actually gets a chance to look at their tax returns and understands what their current adjusted gross income is. And typically that individual is going to be your lender.
Gotcha. Thank you.
Cool. Yeah, sure thing. All right. Now this one, as we'll call Michael Winger's slide here, because this is exactly what you were talking about. So you can write off your property tax as well. But for most of our conversation today, on the next two slides, we're going to get really deep into the numbers. And that's where we're going to have like a big conversation around that. And like I said, hopefully we can answer a lot of questions about it. But this right here is something that is important for you to be aware of, but I don't necessarily bring too much of this into the conversation with the client as far as a tax benefit is concerned, because you are allowed to write off your property tax as a tax deduction, but there's a really big catch with that. And that's that you're capped at that 10,000, like Michael was saying, but that includes the state tax, the state income tax. And so here's a sample W-2 up here for someone who made gross $74,399, and their state income tax that I had highlighted, for some reason it's gone. But for the people on Zoom, the state income tax section is in the bottom left-hand corner of the W-2, because you can't see where I'm pointing, is at 3629. So that means if they're, thanks, Haley, or whoever's circling that, that's exactly where that is. So if your property tax exceeds, or if your property tax plus that state income tax that's already been paid exceeds 10,000, you don't get any additional benefits for the deduction. Okay, and your tax accountant would go over that with you, but just kind of keep in mind that if someone makes, maybe a couple $100,000 in a year, they're probably paying just about, if not already, $10,000 in state income tax, meaning any additional property taxes that they're paying may not actually be tax deductible because they've already met that 10,000 max. Does that make sense? Cool. All right. Okay. So this next slide, did you have any more questions on this one? Okay. So on the next slide, there's going to be a lot of numbers, and we're going to go nice and slowly through them so that everybody can understand them. But it is going to be a lot. And the most important thing before we actually take a look at it is that you guys don't need to necessarily understand how to put these things together or even go over it with a client to explain all of it detail by detail. The most important thing as a real estate agent is to just understand that when we go through this process, you can see the actual tax benefits of owning a home so that you can say, during a conversation, be like, look, it's just crazy if you with your tax deduction from the mortgage interest that you have on there, if you treat your home essentially like a savings account and a way to eliminate income tax, you can actually, if you shift your perspective of the payment of the mortgage, you'll understand so much more how people can truly generate like generational wealth through owning real estate. And I'm not talking about investment properties. I'm talking about just owning your own primary residence. Because the way that the government tax code is built is 5% of it explains like what you actually have to pay. And the rest of it is all the write-offs and how you can get around taxes, right? The way a government, and specifically the US, incentivizes individuals for home ownership is they provide tax incentives. So like, for instance, right now we have a push on tax incentives for electric vehicles. That's the government saying, hey, we want to reward individuals for contributing to this specific industry, and we're going to incentivize that through tax incentives. And that's how the tax code has been built ever since it started getting into, you know, everyday workers after World War I. And so it's important to understand that this is the government rewarding us for homeownership. And once you can kind of effectively communicate that to a current renter, it'll help kind of get them over the hump of understanding really why homeownership is on a, you know, a first glance appears to be more expensive than, you know, rent. All right, now Haley, let's take a look at the second slide, or I'm sorry, the next slide. Cool. Can't really see how clear that is, but there is a QR code in there. Who's having a hard time reading the numbers on this?
No, not at all. What numbers?
I sure
What
can't. Oh, do you have something that can help with that?
Yeah, Isaac, so it's not gonna help.
No.
No.
I can only help with that number. I can't help with these.
Oh. Okay, cool.
Have everyone scan the QR code.
Yeah, everyone scan the QR code then. Let's do that.
And Mike, I'm like
Yeah.
super hard of hearing. Can you just talk a little bit louder? Because I want to hear what you're saying.
Sure.
Thank you.
I didn't know I wasn't being loud enough. I
No,
thought I
I'm
was
just
too
saying,
loud.
I really want to hear you. No, Robin and I are deaf back here, so.
What?
So it's great.
Drake is deaf in 2 ears.
Huh?
Did you get that scan, Gina?
It's not water
Did
in
you
my
just get that?
ear.
Or-
No.
No, okay. It's what you've seen before with Jorge, the
Yes.
mortgage coach
Yeah, yeah.
type thing. Yeah. So,
Am I accepting the disclosure?
oh, yes, you'll want to, yeah, all that it says is that accepting the disclosure just means that your interest rate, your actual interest rate.
You're talking
could
about that QR code that's up in the corner there?
Yeah.
Yep.
Does that take us to the water code?
It takes me to this thing.
So this QR code, I guess I should explain to the people on Zoom as well. The QR code that's currently on the screen in the top right-hand corner is the QR code that will take you to exactly this presentation that you see the screenshot of right now, that for some reason the definition of this TV just doesn't seem to get good. Are you comparing, Robin? Are they correct? Okay, cool. So what you'll see under the summary section, first of all, let's talk about just a quick overview on each one of these. Sorry, am I in the way?
No, I got it.
Let's talk about a quick overview of each section. So let's start with the net monthly payments. Net monthly payments for obviously a $2,500 renter is going to be $2,500, right? It's what they pay every single month. Net monthly payments for 3.5% down FHA, 5% down conventional, 10% down, and 20% down are all just about, if not a little bit below that. And it's important to understand the reason why those numbers are there. And we'll get into that in a little bit because we have the total payments that are highlighted. Actually, let's do that right now. So when you're comparing all of these, are you guys able to see these on your screens as well? Awesome, cool. Thanks, Robin. You're so helpful. All right, so for the first one, 3.5% down FHA. Under the total payment, you'll see the total payment is $3,467.53. Now the tax benefit on that on that loan is going to be $445.80 per month. Now, the last couple slides we've looked at, we understand how to calculate a tax deduction, right? So we understand that part. Now, the second line down is going to be principal paid. Now, the reason why that's listed in there is because that's recoverable. That is not a cost to own a home. That is you putting more money into your home because you can get that money out at a later time. It's just like you're paying down a loan on a vehicle and you're owning more of that asset. And so another way this principal paid could be viewed is a forced savings account, right? Because when you meet someone and they say, I'm a renter right now, and you say, that's great, you're wanting to buy a home, right? So how much money have you saved up? That's what everybody asks, right? How much do you have like for saved up for a down payment and closing costs? And they'll tell you. That's a great opportunity to congratulate them on how much they've saved up. The next question, a great next question to ask is how long did it take you to save that? And you can also just say, how much do you put aside each month to, buffer up your savings so that you can purchase a home? Most people that you'll talk to, they're putting $500 to $1,000 away a month. And so once you own a home, you've achieved that. You don't need to continue to throw that $500 in savings if you're saving for owning a home. You've now created your own forced savings account in your home. And so that's why shifting your perspective of what a total monthly payment is compared to a net monthly payment is important to understand, because it's that conversation that we have with our clients that helps us really kind of break down those barriers of understanding what goes into owning a home and really having a mortgage all in all. So now that we've kind of explained, the breakdown of the highlighted section in the summary part, which is on the left side of the screen for all those of you in Zoom land. Let's talk a little bit more about the rent versus tax benefit over the course of 60 months. So first of all, 60 months is 5 years, right? If you're paying $2,500 a month in rent, in 5 years, you've paid $150,000 in rent. Like that number just like is shocking to me. And it's shocking because it's so real and people just don't notice it. They just don't realize that every single month that money's going towards somebody else's net worth, that they're growing every single year, and even more during the pandemic because of just values shot up so fast. So in this second section, the rent versus tax benefit over 60 months, you have the $150,000 over the course of 5 years equals that 150 in rent. Now, the other smaller yellow sections is going to be your tax benefit over the course of all 4 of those different loan options. So the red right here, this is money you've actually spent that is not recoverable. This money right here, the yellow, yeah, great job, Haley. You're doing the perfect things. I love it. Thank you. All of these yellow things, that's the government giving you money. That's straight up the government giving you money through the US tax code that says, thank you for contributing to real estate and home ownership, because that's what we've incentivized our citizens to do. Like, this is just straight up money from that based on your tax rate. Now, if you're now unemployed and you don't pay any income tax, then maybe you don't get that money back, but you may not keep your house either. So next section, this is really what I like to call the generational wealth section. Yeah, the bottom right, Haley, with the green bars. So the net worth in 5 years, obviously, when you're renting, you really are not gaining any net worth, right? I suppose this might be a little bit misleading because you would still maybe have that. Let's say you had $27,000 in the bank. You might still have $27,000 in the bank, but if you put that money in a year or two ago, that $27,000 is probably not going to get you as much as it would have a couple of years ago compared to now, because inflation eats away at the money that's in the bank right now. And so the best way to combat or really compensate for inflation is by owning an appreciating asset. And so everybody that's talking about how inflation is just eating away at their earnings right now, and how interest rates are going up, and it's just so dire because everybody, we need housing. It's a requirement. And people are trying to purchase homes, but it's just more expensive. And so it's important to understand that trying to get over that initial hurdle starts to really snowball in the coming years. Because as you can see, over the course of only 5 years, Under an FHA, you'd have an actual net worth, this is equity in the home of 142,000. All the way down to, you know, if you had 20% down, your net worth would be 213,000. Now, if you guys scanned this QR code, because this is what's up on the TV screen or the Zoom screen for you guys there, is just a screenshot. But if you scan this code, you can click on the more info button and you'll see when it comes up, and yeah, she can't click on it there, but when you click on that, you'll see the actual property appreciation rate that's listed in. And I put in 4% appreciation because 4% annual appreciation over 5 years, maybe over 10 years, that's a safe average, right? Even though we've gone through a really crazy appreciation time over the past 2 years. Haley, maybe let's go to the next slide. Oh, actually, hold on. Sorry, go back. Sorry, Haley, go back one slide. I'm so sorry. There we go. All right, so another thing I want you guys to understand when you scan the QR code and take a look at it there, under the summary section, you can click on more info, and that more info within this summary section is going to give you a breakdown of what this total payment actually is. And so what's important to see in there is the breakdown between principal, interest, taxes, and insurance. But also you're going to see in there that even with all of this, that includes a monthly HOA of $300 a month, which is, as we all know, kind of average. You know, it's a good ballpark to have, but I want you to know that because it's important to know that this is a total cost analysis. That this is what this kind of report or this mortgage coach presentation is called. These are the actual things that I give to clients once they're pre-approved, but sometimes even when they're not, just for educational purposes, because it's a powerful tool to help people understand the ins and outs of the total cost of the home. Okay, sorry, Haley. Now let's go ahead and go to the next slide. Okay, so this one, if you guys want to scan this, so this will be a new presentation, so you guys can scan that if you want. I'll step out of the way. Actually, while you step out of, or while I step out of the way and you scan that, I'm gonna take a sip of this. So on this one, believe it or not, there are people that are out there that pay $3,200 a month in rent. I wasn't so sure that that was a thing, but it is, and it's shocking. But you guys, I'm sure, talk to people like that, right? Yours didn't change, right? You can scan it. Oh. You got, sorry, Bronson, let me move out of the way. You got a big picture of my head.
That's working too.
Oh, yeah, cool, good.
Sorry,
Oh, there you go.
I keep taking pictures of you instead. I'm sorry.
32.
Okay,
There we go.
Okay, cool, we're all in the same presentation there?
yes.
Everybody good on Zoom? Cool, thanks, Isaac. You're the only one I can see up there, so I really appreciate the thumbs up.
Bearded man.
Yes, the bearded man, as he said. Cool, so on this one, $3,200 rent versus a $670 single family. So this is going to be maybe someone who, maybe this still is a first-time home buyer. But these types of renters in the higher price points, they still have a tremendous benefit. And typically, if you're paying $3,200 a month in rent, you're probably someone who makes a decent amount of money because they had to qualify for that. And you know what? That means they may even be in a higher tax bracket. But really, the tax bracket that I used for all this is just the 24%, just because I want it for conversation's sake, just so that it's nice, easy, consistent numbers. But just keep that in the back of your head that if you're paying $3,200 in rent, you're making more money, which means you're spending more money on income tax. And these are the type of people, when you see someone who's paying even above, $2,800 a month, those are the kind of people that like, oh my gosh, really? You qualified for that? That's amazing. But you don't own a home, so you're paying a lot in income tax. Did you know that? These are the kind of conversations that we should be bringing up to people who say, yeah, I, rent a really nice place for $3,000 a month or $3,500 a month, as I've heard. Just be like, wow, you're spending a lot on income tax. And, I have a way that you could save money on that. There's a lot of books out there that we all read in real estate, like what's tax-free wealth, the Rich Dad, Poor Dad. It's all based around trying to limit your income tax that you pay. And this tried and true tool of not this tool, but I'm talking about the homeownership tool, has been a part of the US tax code for a really long time because they want to incentivize people to own homes. And they're still doing it today. So taking a look at this, also same principle, you can click on the more info button. You'll see the full breakdown in there. These are the rates that were a couple days ago. We've had a lot of volatility the last few days, so it's a little bit different than what this says, but we're somewhere in here, which is the important thing to understand, because people are going to have conversations with you that say things like, I heard on the news that rates are 8%. I've heard on the news that rates are 6.5 or 7. I got that question today. I see it everywhere. I don't know why the general public is hearing these things or how they're hearing it, but it's our job as industry professionals to help educate them, because there's just so much benefit in owning a home. But keep in mind, when you first purchase a home, you're going to, if you're going from a renter to a buyer, you don't have a lot of money saved down, you're going to be in this 3.5% down FHA section. Now, if you're taking a look over a presentation like this to a client, you can take a look over the 3.5% down. And if they go, oh, wow, yeah, I don't know how long I could do that. That's just like, that's just a lot for me to handle. You got to remind them that the further the longer that you're owning a home, you start to move into these sections, like the 5% down, the 10% down, and 20% down, because the only thing that's different between the conventional ones, keep in mind the FHA, you have the higher FHA mortgage insurance premium, but once you've refied into a conventional, or maybe you started out with a 5% down conventional to start with, the longer you're in that home, the more your loan amount goes down, and the more your loan amount goes down, the more, when you do a refinance, the more close to these lower numbers you'll be. Now, has anybody looked at rents like 10 years ago compared to today? They've all gone up, just like nobody's lower today than they were 10 years ago. But people who are in mortgages had, if they're still in that same home 10 years ago, and they've refied, maybe it was during the pandemic, or maybe it even wasn't during the pandemic, just over that course of 10 years, regardless of the interest rate, you're still going to have a lower loan balance, which means a lower monthly payment, which means it's cheaper for you and you can grow more of your generational wealth. And so the important shift in the conversations that we need to have with these renters that are looking to purchase is to try and get away from the term rates, because they're just being bombarded with the news right now about how horrible rates are. It's like, let's get away from that term. We understand rates are higher this year than they were the last 2 years, but also we can run around and frolic in the, in the parking lot with our friends in the parks without having to worry about the pandemic as much as we did then. It is a different world that we're in. So it's not fair to citizens or individuals to compare last year to this year when it comes to the monthly payments on mortgages, because it's just a different world. And so shifting that conversation away from rates and towards budget and growing generational wealth is the easiest way to just cut through all the fat on that, to be able to just be like, let's talk about what we can do even with the current economic environment to actually help you grow generational wealth through real estate. because it's something that, as you can see in the net worth in 5 years section, $200,000 in 5 years. And that's with only putting 3.5% down. It's just a no-brainer, right? And so these are the kind of conversations that I'm just trying to help shift your perspective to have. Yes, Jean.
Is there enough of a difference in the 7-1 arm to present that as an option and just say, you know, if rates are different enough in like 5-6 years or whatever, you can refinance at that time?
Yes and no. So what that applies to is, at the moment, when you're in a, I feel like I have Fritz in the back of my head talking about the shift market. So when you're in a shift market like this and interest rates start to rise, you see exactly what you're talking about, the introduction of adjustable rate mortgages into the market again, right? Right, as of right now, there's a lot of great ARM products that have a lower introductory rate on jumbo loans. But as of right now, the conforming and high balance loans, which I guess I should say, the conforming loan limit is all of the loans up to $647,200. That's the conforming range. And then loans between the $647,200 up until $970,800, those are considered high balance. And so all of those loans in conforming and high balance, there's not a lot of ARM products that are better than fixed rates at the moment, but that could change in a week, to be honest with you.
I just thought because it's like, it's feeling that way, you know, that
It
can
is.
come up.
Yeah.
And then at that point, then there's not always the focus on a 30-year fixed, you know,
Mhm.
because then like if they get a good enough deal on like a 7-year arm or something like that, but
Absolutely.
if it's not here now, I see what you're saying.
Yeah, it is here on the jumbos. On the jumbo loans, which is going to be anything above a $970,800.
Yeah,
But I guess, you know what, I should qualify that statement with, that applies to LA and Orange County. We have high balance loans. Now, if you're purchasing a home in Riverside or Canyon Lake, I think is the one that's out there, that I was just talking to my boss about that last night, who's, you know about Canyon Lake? Okay, good. Those kind of, like, what are the homes in Canyon Lake look like? Like values, what do you think?
They're like 650 now.
Oh, okay, that's not that bad. I was thinking of, maybe I'm thinking of a different area in Riverside County that's in the 8s and 9s.
Yeah, not Canyon Lakes.
Not Canyon Lake, okay, then I'm thinking of a different location, yeah. Either way, the important thing to think about it when you're in Riverside County or San Bernardino County, they don't have high balance loan ranges there. So that means any loan that exceeds $647,200 is considered a jumbo loan. Okay, and so when that's all you can do is a jumbo loan in an area like that that doesn't have high balance, that's when you have the opportunity to look at some of those adjustable rates like you're talking about. And so that's something you're going to see a little bit more often in those markets, but the high balance range, not too much of a shift on it yet.
Okay.
But honestly, that can change very, very quick.
Yeah.
Great question. And do we have any other questions based around this concept or loans in general? No, I'm good with ending the class whenever you guys are, but I guess we should also be asking the Zoom people if you guys have any questions.
So you had mentioned high balance and jumbo loans. What was the smaller third one?
So the smallest one will be conforming loans, and that's going to be loans up to $647,200. And then high balance is from that number up to $970,800. Thanks, Naomi.
Okay, and then jumbo is anything above that.
That's correct. Yeah,
Awesome, thank you.
sure. Conforming high balance and jumbo, yes.
Hey, Mike,
Do you
how
have
do
any
I
questions?
call you or text you?
How do you call me or text me? Well, first of all, I am in my office all the time, but
But if you're at home, don't you just call?
you can absolutely get a hold of me, first of all, by just asking me and I'll text you my info, or for anybody in the Zoom world who doesn't already have my contact info, you can. when
And the
you-
QR code.
Yes, exactly. That's right, Jasmine. We're in, or my info's in the QR code. And also, here's the other thing that I really should have told you a while ago. This is not just something that I build to show you guys. Like, this is something that if you're talking to someone that you meet at an open house and you say something like, or they say something like, yeah, we're, thinking about buying and we're renting right down the road, but you're holding an open house in like Rossmore or something like that. And you go, oh, wow, you're renting right now. Gosh, how much is the rent in this neighborhood? And they tell you. And then you say, well, what kind of home are you looking for? And maybe they don't tell you the sale price, but maybe they tell you how many beds and baths in the neighborhood. And luckily, you guys are all real estate agents and you can probably figure out which price point they would be looking at, right? Once you identify those two things, all you got to do is shoot me a text that says, what does it look like for a comparison between $2,783 a month compared to purchasing $650,000 SFR? And I'll just build this. This doesn't take me long. It's like a few minutes. And then I'll send it over to you. And one thing that I didn't put in there, but there's, when you scan that QR code, if I put a video in there, a video just pops up. And I can explain all of this stuff that's in here. I can explain to your client or prospect even what the difference is between the total payment, the tax benefit, the principal paid, and the net monthly payment. And I can just throw that together, text you a little link, and you just send that over to me. Like this is what I'm trying to help you guys with, which is the conversion process of renters to buyers. Like I said at the beginning of the class, you guys don't have to break this all down to your clients. You don't even have to pull it up and point it out and explain anything to them. All you have to do is understand the concept of how even with today's interest rates, there's a huge benefit in owning versus renting still today. And rents are still going up, so it's gonna probably continue to get better. Yeah, Rick?
Is it possible just to be proactive and have a few of these pre-made
Absolutely.
and just have them in our phones? Because
Yeah.
That's cool, yeah.
First of all, you have these two that you can start out with. And I can, let's see, because I could give you URL links to it, or maybe, what do you think would be the best way for you to organize it? Like to have like multiple ones, what would you like? And I'd love to hear everybody's input on this.
because I'm not as techie as the kids. My first
Well,
thought was,
then-
shit, I need flyers.
Well, then.
Sorry. But it's true.
Well,
So,
Then, yeah, tell me what you think would be best for you. Then.
I mean, I think it would be good. I think it would be good to have in my phone,
Mhm.
a picture of the flyer.
Exactly.
You know,
Okay.
different ranges. I'm not worried about the higher purchases, because most of them, I think, understand this, but like for the renters, I mean, like you said, maybe something, I'm sorry, I talk to somebody, I don't even know what the person is.
That's a great idea, like somewhere.
Yes,
Yeah.
I want this image somewhere where I can maybe just text them a picture.
Whether it's a
Okay.
PDF or a JPEG where you're like, here.
Literally a screenshot.
Yeah, I was thinking.
Yeah. Yeah. So yeah, that's called a screenshot. And
I love screenshots. I do
Okay.
screenshots all the time.
good. Well, you let me, so first of all, like I said, you can absolutely use both of these. Like I said earlier, Haley will be sending everybody a copy of this PowerPoint presentation. So you can just scan those in there if you want and save them wherever you want, or ask me to text them to you if you are unfamiliar with PowerPoints, if that's too techy for you.
These are much.
I don't know your level of tech. I'm not trying to.
You know, it's
Yeah,
like
yeah.
this. It's like this.
Okay, cool. Well, then I'm here to adjust to whatever your needs are.
But
Fine.
I think, and I'm not speaking for you, but I think I know what you're talking about. Is that, because a lot of people are not gonna bother with the full PowerPoint, because they're like, I'm not at work, yo. So they may wanna just see a quick picture. So I'm thinking like, instead of a PowerPoint, they're going through a bunch of stuff, where you're like, you can text it and they see one
One page.
PDF or screenshot or
Just one
something.
page, just to give them,
Just to give a quick idea.
an inkling. I need to call Drake for more information,
Absolutely,
Yeah,
Yeah.
yeah.
absolutely. I can put that together.
because sometimes less is more.
Absolutely.
Yeah.
Because really, it's just like what's the main key piece of marketing? Isn't to get someone to buy a house, it's to get someone to call you,
Conversation.
right? Yeah, it's just conversation.
A conversation
Yeah.
starter. So
Exactly. Cool. I can do that. I'd be happy. And yeah, we'll get a few different price points, maybe different scenarios. I'd love to hear feedback from all of you
And I
as
can
far as
call
like
you.
what you would like to see. Yes, you can.
But I could call you and just say, okay, because you know some of my contacts are in LA, and I could say,
Mhm.
oh, well, this is, because they pay way too much in rent.
I
you
know, right?
And I could say, this is what the rent is, and then this is what, like some of the houses are, and maybe a specific piece for that.
Yes. Absolutely. Yeah, that's what I mean. Like, I'm happy to give you guys a bunch of different templates of like ballpark figures.
Yeah.
But I'm also totally fine with giving you a specific price point with a specific rent payment.
Well, I'm thinking like
Because-
ballpark for LA, like, you know what I mean?
Yeah,
Like,
no, of
or
course.
whatever,
I'm
you know.
fine with any of that, because truly, like, when I first started building these, to be completely honest and transparent, they were very daunting. Like, I was like, oh my gosh, like, where do I put this number? Because I put in a number and all of my graphs would get totally different. And it was, confusing to me at first, but I'm very much more comfortable with it. And once I got comfortable with it, then he was like, you gotta teach class. So I'm listening to what his advice is, because this is a really, powerful tool, I think, to communicate numbers to people and communicate the benefits of homeownership. And this is one of the things I can do with this program. The other thing that I use it for is anytime someone's pre-approved, as soon as the pre-approval is complete, I give them essentially this whole thing without the rent part. And I give them, hey, here's your pre-approval amount. Here's all the different loan options that are available to you. You can do 3.5% down. Yes, now, again, these days, they're coming back out with second liens. So purchase money seconds are coming back. You guys probably remember 80-10-10s, and there's now 80-15-5s. They're back. The back end debt to income ratios are a little bit lower. They're 45 on the back end. So hopefully that keeps us a little bit cleaner on this, time around on the cycle. But understanding that there are so many more creative options out there now for people, but how do we effectively communicate it to them? And that's what this program does for me as a loan officer, because I can only try to explain things so much without visual aid. And this is really what's been a game changer. So I've actually had some agents out of this office that I've sent a rent versus own comparison to, and the guy looked at it and he said, okay, this is crazy. I don't know why I'm still renting. He has like, 50 grand in the bank and he's paying like $2,600 a month. And he was like, I didn't realize how much money I'm leaving on the table by not owning. And so he just saw it once and was like, yeah, okay, I want to buy a house now. So it's just shocking that a lot of people, it's not their fault. They just don't know because nobody's been able to effectively communicate it to them. And a lot of people typically have their parents effectively communicate it to them. But what about people who are underprivileged, who maybe their parents have rented their whole lives? nobody's given them the opportunity to learn about the benefits or had a parent to kick them and be like, you gotta buy, like right away. And so they just go through life skating and renting, and
Well,
it's,
most homeowners can't explain this. Even if
well,
they're homeowners,
agreed,
they
yeah,
don't
even
explain
homeowners,
it.
yeah, exactly. And it's just because it's, it's complicated. There's a lot of numbers that go into it. And honestly, I guess, yes, you're absolutely right. They can't explain it, but having a parent that's like, you need to buy, I can't explain it, but like, you have to do this. Like, there's no kid of mine's gonna be out there renting and not building equity. Like, I get that. I hear that from a lot of parents. I mean, that's why parents are co-signing and gifting their children funds. It's not because they, want to spoil their children. It's because they know they want them out, that too. But really what they want to do is get them into a position to where they know if they're building equity at a young age, they're going to be fine when they get older. When are you giving Chloe her money to buy a house? Never? Okay. Well, everybody's.
I mean, I also don't want to give my money away knowing they may lose my money. So, each one's at a different status level of when they might get their funds.
Strings
Cool.
attached.
Yeah, exactly.
But I do think that
Thanks,
these
Vic.
last two images, for sure, are great conversation pieces.
Exactly.
On social media, right? Just
Yeah.
the visual of like roughly 5 years I paid $150,000
Yeah.
to somebody else's mortgage, which is
Yes.
often what I say to
That's
people,
crazy.
right? I always say, you're already paying a mortgage, you want to pay yours or somebody else's. But the reality
Yeah.
is they really are when you think of it like that.
Yeah.
So,
And when you talk to the, I don't know how we can get the bar off of the bottom, but when you look at, oh, thanks, Haley. It should drop soon. When exactly what you're explaining for that type of person who is paying rent right now, this is you're like blowing my mind, Leslie, right now. Think about that person who's paying that rent, that on this screen, 3,200, it's $192,000 in rent over 5 years. Who in here has rented for more than 5 years in their life? Yeah. I haven't done the math for mine. And I'd probably encourage you not to do it on yours either, because we're in real estate and it would probably be pretty depressing, right? But the thing,
I'm gonna start crying.
nice, Naomi.
I'm gonna start crying.
So keep in mind, like when you look at over the course of 5 years, you're growing your net worth on an FHA loan, on a property like this, on an FHA loan, you're growing your net worth $214,000. But remember, people who own an investment property, they're not in the FHA range. They're in the lower loan amount range and no mortgage insurance range. So they're growing their net worth so much faster. It's crazy fast. You're looking at 317,000 on this one. Keep in mind, you got to subtract their initial down payment, which is 134. So even that's like 200,000.
The reality is that number is probably even greater because this is assuming that they're paying that mortgage, which they're not, because they're an investor, which means somebody else is paying.
That's right. So they're getting that net worth. Yeah, they're getting that net worth
Yeah.
plus
Plus
you're right,
value
plus
of
the extra cash flow.
They didn't put that money in.
Exactly. And so as renters, are we going to continue to let these investors rule our lives? I feel like Dwight from The Office.
Right?
It's like,
I know, he's
Yeah.
starting to march. I'm in.
yeah.
I'm in, buddy.
It's like we gotta be the people that light that fire in all of the renters out there right now, because it's certainly depressing if you see, the facts about home ownership on the news right now. It's depressing, and we're here to correct that.
Because the news
And-
is usually so positive. And all.
I know, right?
Yes,
Yeah,
always.
so very true. But I think that wraps up
They don't want
about
everybody to be
our
sad.
hour. So I'll let
No, it's super helpful.
everybody in Zoom land go. Thank you all for watching.